So you might have been thinking about creating new rental units for your next real estate investment, and you might have heard that you can save on HST when you create them because the government's been really pushing on new housing supply. But how does this all work? And what steps do you need to take to get this HST back? And is it really worth it? Well, in this video, we'll break it all down with a focus for the Toronto rental market. But before we do, make sure you like and subscribe for more Toronto real estate investing tips. When the government says you don't need to pay HST, what they mean is that you actually need to pay it up front and then get at least a portion of that back as a rebate. Now, how much you get back depends on factors like the value of your new unit, the type of rental it is, and its location. And in this video, we'll be focusing on Toronto rentals, which is in Ontario. Now, you can get back 1.8% of your unit's fair market value from the federal side of the rebate, as long as your value is up to $350,000. Now, if your property's value goes over $350,000, the rebate percentage gradually decreases and eventually goes down to zero, nothing, once the value hits $450,000. Keep in mind, the fair market value here is super important. The government calculates the tax payable and the rebate based on the value, and this is typically confirmed by a realtor or an appraiser, not your actual build costs. So if your build costs are actually lower than its appraised value, then you will have to top up more tax to make up for the amount owing first and then get your rebate after. And so you do end up with a lot less in your pocket in the end. Now, if the value is less than your build cost, then you might not get as much rebate back as you hoped either. So in other words, the best case scenario is if your build cost is as close as possible to your finished value. Now, let's talk about the provincial portion of the rebate. And here's some better news. You do get up to 6% back here, up to a maximum of $24,000. And unlike the federal rebate, this rebate doesn't disappear if your value is too high. And so if you look at the full picture, you will see that the maximum rebate does tap out when the value hits $400,000. And if you wanted to get the best percentage of rebate back, then you would want to keep your cost and values under $350,000. You might have also heard about an enhanced HST rebate where you can get all of your HST back, both from the federal side and the Ontario government. And yes, it is possible, but it is definitely harder to qualify for this because you will need at least 4 private apartment units or 10 private rooms or suites, and at least 90% of those units need to be long-term rentals. Let's dive a little bit deeper and figure out how you can actually go about getting these rebates. Now, step 1, you do have to rent out your units first. And then number 2, you will have to fill in 2 forms from the CRA website, one for the federal portion and one for the provincial portion. And I'll link both of these in the comments below. It'll also ask you for an HST number, but don't worry if you don't have one. The CRA will create one with your application if you don't. And it also doesn't matter if the owner of the property is an individual or a corporation, because a lot of people do invest in a corp. You can get a rebate back in both cases. Make sure you attach your rental lease agreement to your application, and you will have to snail mail it out because it seems like they don't take online applications yet. And then be prepared to wait. As of summer of 2024, it does take around 6 weeks for the CRA to acknowledge your application, and possibly another 6 weeks plus for processing. And then if you do get audited, then it might take you a few more months on top of that just to sort everything out. It is a big process. So the big question that you might be waiting for is it really worth it to create more rental units? Well, to us, the short answer is yes. Turning a single-family home into multiple rental units can boost your rental income and cash flow. And even before considering the rebate, this was a smart move, and it can help you qualify for more mortgages if you want to grow your real estate portfolio. Now, with the rebates, your costs do go down more, which means more gains for you. What about the enhanced rebate? Is that worth it? Well, you definitely need a much bigger construction budget to meet the rebate requirements, but it could be worth it. Having 5 or more units does open you up for better financing options like the CMHC MLI Select Commercial Mortgage, offering you better rates and better terms that can improve your return on investment. And you end up getting better HST rebates here too. For example, if you do qualify for the full 13% rebate over 5 units, each unit worth $350,000, you can get an extra $18,000 back per unit, and that ends up totaling an extra $91,000 more with the enhanced rebate for all 5 units combined. So if you are thinking about investing in a multiplex in Toronto, we're here to make it easier for you. Whether you're buying or building, we're here to help you through every step of the way, from finding the right property to securing rebates to ensuring that your investment pays off. Our real estate sales brokerage specializes in investment properties and multiplexing in Toronto. Whether you need a ready-to-go multiplex to invest in or you want to convert a single-family home into multiplex, we can help you make smart choices. First of all, we'll chat with you to find out what exactly you're looking for, show you how to find good deals, and help you pick the best investment property for you. If you need renovations, we've got trusted contractors and can guide you throughout the entire process. And if you need help renting out or managing your property, we're here to help too. So if you are ready to get started, just head over to this link and let's chat.